Please feel free to interrupt me if there's any disruptions in the presentation, but I would trust our connection to be very stable. Then I would presume that everything is clear. Now, as I said, good evening to everyone. No, this is our formal formal start of our lecture. I will be lecturing to you on the fundamental concepts of managerial economics. Now, this will stretch us for like 4 hours, but this lecture is only good for 2 hours. So I'm only going to lecture to you just a half of the material that is intended or allotted for module 1. So again, managerial economics is a field in economics, which is also an application of uh, business concepts that we say economic concept for business decisions. No, so managerial economics is a very important field in uh, business business management because it provides the business decisions with enough economic and theoretical basis for making a decision, so that decisions are not only based on information, but it's also based on theory, because the theory provides the basis in which the decision becomes robust and also becomes acceptable to anybody that will question the truthfulness of that particular decision. In other words, it gives the business decision more strength in terms of really being able to accomplish a certain issue. Now, why should we study managerial economics? No? Why should we study managerial economics? Uh, it's not as straight as like we want to get rich. No, now it can be something like understanding the rudiments of economics, not being able to understand business. It's also will lead you nowhere. No, so that providing the economic foundation for business decision will allow us to really have a rail track or have a template by which decisions are tractable. No, you can track your decision in terms of the rationality of that particular decision. Now, it can also simplify things in business decisions, and then it will also, given the what's this the application also of economic theory and proper use of this economic theory for business decision, well, it will enhance. Not necessarily it will make the business successful, but at least the likelihood of success will be much higher, because at the end of the day, it will be the human person himself who will make a decision. The theory cannot make a decision for you. It's really the decision maker who makes the decision. The theory will only be options and possibilities how to make that decision more sound and also effective. Okay, now in terms of the usefulness of managerial economics, well, it is, as we have said, a valuable tool in analyzing business situations. Why the business behaves this way, why customers behaves in that fashion, that can be explained basing on some fundamental economic theory. That's where managerial economics is really being made useful. No? Then managerial economics also provides useful insights into facets of business and non-business world. No, you have in management, we look at business related decisions. There are also non-business related decisions or business world. No, also even in the managerial economics, even is that our knowledge on economics is even useful even at a household level, because the smallest structural unit of management actually is the household. No? You manage resources in the household. You manage everything, your money, your whatever you have there in your house, in the house. You manage it in order to accomplish certain purpose. That's actually management. No? More makarelate din ang mga housewives. managing a managing something under constrained uh, optimization, or something like constrained rationality. That means to say you're only given this much of money by your husband. You have to stretch that out in order to make both ends meet. Something like that. No, it's a constrained optimization already nga environment, and rightly so. Our knowledge in economics will be made useful in that sense. No? So essential definitions. So when we talk about managerial economics, there are two things. We see manager, and there is also economics. Okay, why do we have to say managerial economics? Why not simply economics? Well, for the very reason that this is a science of decision making. Okay, management is a science of decision making. That's why we have manager. Now, the economic side only provides us with the with the logic, with the reason, with the fundamental basis of making the decision, and options and possibilities. But at the end of the day, it will be the manager who makes decision. Now, what do we, well, how do we qualify a manager? You have that in your 1201. A manager is a person who directs resources towards an organization goal. Okay, if you are a manager, you are doing something in order to direct the resources of the organization towards a certain goal or certain objectives. In other words, you do something, direct efforts of others and resources, then you achieve something for the in relation to the goals of the organization, like uh, purchasing inputs, for example, of production. That's one thing. That's one decision. Making other decisions, such as pricing decision, quality decision. These are basic decision in an organization, especially business organization, and you need a manager to do that. The manager needs all the helps, but at the end of the day, the buck stops at him. No, he will be the one to make to make that decision. So it's very important. A person who directs resources for in order to achieve the goals of the organization. Now there are two things. You have the resources can be two things. You have physical resource and you have human resource. Physical resource, ang daling i-manage, no? Very, everything is controllable. What makes decision making complicated in terms of managing resources? It's the human resource that is difficult to manage, because human resources, there are a lot of hidden agenda. There are a lot of hidden talents or hidden motives, no? So you need to really use an innovative strategy in economics in order to uncover those motives or incentivize those motives, so that it will accomplish eventually the goals of the organization. Another is economics. Well, economics is the science of making decisions in the presence of scarcity of resources. Now, economics is really is really a social science that really stems from out of the scarcity situation. If resources are not scarce, there's no need to study economics. No, it is because of scarcity. That's why economics is very important. You can think of anything that is freely available. Why should you economize? You study economics because you want to manage something that is scarce. No, so it could be production of goods and services to achieve these goals. No, these are resources that you are managing. So decision making is important because it implies scarcity of resource, that even when you make a decision, you get even to uh, go with the from one step to another. No, so the center for the essentiality of economics is centered upon the scarcity of resources or goods or services. Now, therefore, managerial economics is to study how to direct scarce resources in a way that most efficiently achieve the managerial goals. So, combining the uh, the role of the manager and the science of economics we come up with managerial economics, which is the study of how to direct scarce resources in a way that most efficiently achieve the managerial goal. No? So in its broadest sense, it's the methods useful for directing everything resources from the resources of the household to maximize welfare of the resources of the business. No, so that it's really something that um, achieving the goals of the organization. So you have to have somebody who directs the utilization of scarce resources. Now, you have the manager, you have the managerial economics, you have also a definition of the economics. No, so if anybody of you, I mean, I hope that, I mean, I would assume that some of you have some at least basic foundation in economics. So you your originally understood definition of economics. I remember in my undergrad we used to define economics as the the social science that deals with the efficient allocation and distribution of scarce resources to satisfy human wants. Very fundamental definition, which still valid as a definition. But this time in the masteral level, we sort of we sort of sexify the whole thing. We mean we elevate the definition in a way that is more sophisticated in statement. No, so we still believe in the same fundamental definition, but we use different mix of words to make it uh, more concrete and concise. No? So what do you mean by effective manager then? A manager must be effective, effective in directing scarce resources. Now, if a manager is effective, he must be able to identify goals and constraints. A manager must be able to identify goals and what are the constraints in the attainment of those. And then the manager also must recognize the nature and importance of profit. No? And then another important, essential expectation of a manager must be able to understand incentives. Okay, incentives, incentives there, incentives here. That's how to manage the economies. That's as some goes used to say that also. Economists usually manage the economy by providing incentives, something like that. Well, in a way, correct, but in also in some other ways, it's very partial statement. So another is a manager also must be able to understand markets. Okay, very important. You have to understand your market. And then another thing is you have an effective manager must recognize the time value of money. Okay, the time value of money. The peso the peso you have now is much higher in value compared to 10 pesos to be earned 10 maybe 10 months from now. No, so it's really there's a time value of money there, and then also the manager must be able to understand the usefulness or the utility of marginal analysis. So from number 1 to number 6, these are the essential element that an effective manager or a managerial economics practitioner are expected. No, it's expected to become familiar. No, you have you have to be very familiar on these things, because this will just make or unmake your being able to manage the firm well. No, so first is we need to address on goals and constraints. Okay, what are goals? Goals are something that needs to be achieved, of course. No, in other words, goals makes achieving different goals uh, very facilitated. No, in other words, what are goals? Something that you need to achieve in the future. Okay, it could be the goal could be like profit. The goal could be increase market share. The goal could be say, for example, reduce cost, something like that. So these are the various goals of the organization. It could also be a goal in terms of being able to improve your customer relationship. These are non monetary goals. No, these are also goals that are monetary in nature. You have to, for example, improve your social responsibility. So that's a very valid goals because it means survival of the business. No, so in whatever goals it is, that should be the orientation of the manager, how to achieve that. And then the constraints are artifacts of scarcity. In other words, these are indications, and also these are manifestations of scarcity. That's why nagiging constraint siya, no? It makes managerial decision difficult to achieve. In other words, these are frictions in the decision making, frictions in a way that will constrain, that will obstruct the achievement of the goals. But as managers, we need to be familiar how to deal with constraints. There are constraints that are say for example constant. There are constraints that are not constant. There are also constraints that are manageable, something like that. No, but their function is to uh, prevent us from achieving our goals. So types of constraints, because goals are clearly straightforward, no? Yeah, goals. But what is so concerned in terms of managerial decision is are what is so concerned is that constraints in managerial decision. So what are the types of constraints? One is technology. Okay, if you are in an industry where technology is highly volatile, and you have no control. I mean, you are so outdated. You don't have the access to technology, so you are in trouble actually. At the end of the day, you will find yourself not being able to achieve your goals. So technology could be something like production technology, process technology, or whatever. It could be also like a technology in terms of data management or something like that. No, there are various types of technology, but then again, it can be a constraint if your access is also blurred. No, in this particular factor. Another type of constraints is prices. Prices can be a constraint, especially if you are at the leading firm or leading company. But we have very little control over prices because this mandated by the market. How do we control prices? How do we control prices, do you think? Prices can be managed by managing your what? Your cost. If you manage your cost, you can deal with the price very effectively. You will not be threatened by the fluctuation of price if you have a good grasp and control of your cost. That's why we almost like uh, in managing price. This is, according to others, this is almost like boxing. You punch you punch one or twice, and then you backtrack a little and then attack again, something like that. No, you cannot just uh, uh, face price head on. Sometimes you need to backtrack a little and see what you can do in terms of your price, in terms of your cost. Because the moment you miss something in managing with price, you will also find yourselves um, incompetitive in the market. Okay, so that is very important constraints to consider. Prices. Key fundamental questions. What do you mean by key fundamental questions? Nga mahimong constraints po nato. What are the key fundamental questions in economics? You have whom to produce, what to produce, when to produce, where to produce, and how much and why produce in the first place. No, so these are the key fundamental questions. Sometimes the whom question, you are not actually able to answer that. Whom are you producing? Who is your market? In the first place, you are creating your own problem because you are going to the war without knowing your enemy, or you are going to the no, you are going to the you are entering the industry, and then you don't know whom are you going to sell, something like that. And then what are you going to sell? Assuming you know your market, what are you going to sell to them? Okay, are you going to sell to them what? Physical product, or are you going to sell to them experience? It depends. No, it depends. You are manufacturing in your company, in your firm, or in the factory. You are manufacturing physical product, but in the market you are selling experience, not physical product. Like for example, cosmetics. Like for example, Avon. Avon in the factory, they're manufacturing cosmetics, but in the market, they're not selling cosmetics. What are they selling? They're selling hope, hope of becoming beautiful for all women, and kinsa pa mo gamit anang cosmetics nila. So it's something like that, no? What are you selling? Are you selling something? We have to be very specific so that you will hit the market at the market edge, no? And then another is when. What is the timing of your release? You are you are selling something and then uh, wrongly timed, so you won't also be able to get the right customer, no? So maybe you are too late or you're too early or something like that, no? So where are you going? Location again, no? These are constraints. Entering into a business and then you don't know where to locate your firm, you will find yourselves also very very incompetitive, no? And then how and the why part, that goes without saying na that will also become a constraint if you are not able to really do your homework in terms of really preparing as a con as a manager. So these are the possible concerns: technology, prices, and also the key fundamental questions. It could also be uh, the constraint in terms of, like for example, environment. You can be also you can also be like facing constraint there if government regulation is so strict, is so, you're not able to follow government regulation. That can be a constraint also in being able to achieve your goals, no? Now, so that is fundamental preparations of manager, that a manager must be able to really understand the goals and constraints. Okay, if I could recall, that's the end of lesson one: goals and constraints. Okay, so that one, goals and constraint, which makes the preparation of an effective manager more foundational, no? Because to start working or to start doing as a manager, you need to know where you are going. That's why you have goals, no? According to Seneca, a Roman statesman, ingon siya nga, uh, doing a business is like sailing in a wide ocean. That according to Seneca, if you do not know where you are heading, no wind is favorable to you. Ingon si Seneca, no? So, importante you know where you are heading so that you would also know which wind is favorable to your direction. So that is goal, the importance of goal, no? Then the next very important preparations of manager, or yeah, to be able to be effective manager, is really a manager must also have the knowledge and also be able to understand the nature and importance of profit. Okay, the nature and importance of profit. Now, anybody or maybe non-business practitioner, non-business people, when you talk about profit, there is a negative connotation of profit. In our language, we say panapi, no? Panapi na pud mo, murag ana ba? Now, but here, we need to have a more balanced perspective or look at profit. Profit is, from karon pa lang, I would say, profit is amoral. Okay, dili siya immoral, no? Amoral. Depende, no? It depends on how you look at profit. If you look at profit, being able to serve the best interest of the population, there's nothing wrong with earning a profit. Okay? But if you look at profit, or if you earn profit at the expense of the welfare of the organization, that makes the profit motive more disastrous or negative in that sense, no? Now, the overall goal of most firms is to maximize profit or firm's value. Okay, I repeat, firm's value is based on profit that they are earning. No, so the nature and importance of profit in a free market economy. Now, there are two types of profit. Okay, there are two types of profit. Now, one type or one definition of profit is what we call as accounting profit. Now, what is accounting profit? Accounting profit is the total amount of money taken from the sales, total revenue, or price times quantity sold. That is sales. And then minus the amount of money or cost of producing that particular goods. In other words, sales minus cost of sales, you get your gross margin. No? And then human, you have that makes also become a prop. That will also deducting further the other, the other cost. That makes also that will become already a profit. Okay, a profit or net profit, if we may call it. So this accounting profit is the profit that is really reported in ordinary accounting system, like reported to the BIR, etc. No, so that is the accounting profit. Now, there is also another definition or perspective of profit we call economic profit. Okay. Economic profit is a more general way of defining profit, general and generic way of defining profit. What do you mean by economic profits? The difference between the total revenue and the total opportunity cost of producing the firm's good and services. Remember, kanina total sales minus expenses or cost of producing the goods. But this time, it's more than just the physical cost or there may be the accrued cost in the normal terms of things. No, here in economic profit, total revenue or sales minus the total opportunity cost of producing the goods. Now, there is one very important term that we need to be more familiar. What is an opportunity cost? Because total opportunity cost mo imong i-deduct sa imong sales to get what we call as economic profit. Well, opportunity cost is the cost of implicit and explicit resources that are foregone when the decision is made. Okay, so it's getting more complicated already. We are trying to understand opportunity cost. We are adding another term, implicit and explicit resources that are foregone in the decision. But we'll simplify as we go. No, now first we need to know what are implicit costs. Implicit costs are very hard to measure. Therefore, managers are often overlook them. These are the costs which are not normally valued at common market, say, system or in the normal market system. No, so implicit cost. Like for example, you are renting an old house for your business. You are renting an old house, but that old house has a historical importance in that particular location. So, in other words, if you look at the cost of renting, it's really just maybe the 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 physical cost or the accrued cost basing on what is commonly practiced by other firms. But since you are using a very precious infrastructure, the cost of rental for that particular place is more than just the acceptable rental rate in the locality, because there is a factor, there is an implicit factor that needs to be considered. That is the historical value, which is difficult to value in the normal market situation. So there are other assets, or there are other ways by which you can maybe factor in that, no? Or it could be it could be labor. No? It could be labor. Nga. Opportunity cost could be a cost that could also be, or implicit cost that could be a cost that could have been paid to you if you do full time, but you didn't deduct the full time cost of your labor. You deduct only the uh, maybe monthly or hourly wage of those that are really managing the business. So these are the different aspects when we say implicit cost. What about explicit? Explicit are, on the other hand, are actually the same as accounting cost. Kanang, if you pay, for example, labor, and the cost of the wage rate is 500 per day, you pay 500 per day, well, that is explicit cost. But if you are hiring, for example, just to illustrate explicit and implicit or opportunity cost, you are getting, for example, somebody, hiring somebody, and the monthly wage, or maybe the daily wage is like 500 a day. 500 a day. So you pay them 500 a day. That is assuming common laborer. But if you are getting somebody, okay, if you are getting somebody who used to be a supervisor of a particular, like for example, firm or particular business organization, the 500 is actually just the explicit cost of his time. But in terms of in opportunity cost of his time, that is actually the cost that he could have received kung wala pa siya nagtrabaho sa imong firm, could have received somewhere else, no? So that means to say, for if you own a particular business, and then that business that you are owning cannot pay the opportunity cost of your labor, you just have to hire somebody who has a relatively cheaper in terms of labor, for example, wage rate than you. Because if you work there full time, it's too expensive, because the opportunity cost of your money, of your labor, is really high, considering that you have alternative employment outside. No? That is also one thing for like opportunity cost when it comes to labor. Okay. Now, example. Furthermore, the amount of money you paid per unit is your explicit cost, uh, while the value of your time giving up by attending in the class here is your implicit cost. Okay, so that means to say, uh, uh, the money paid per unit, aning kuan per unit as you attend the class, that is your explicit cost. But then the opportunity cost of your time, that is also the implicit cost, because you might be working somewhere and then earning also a lot also. So that is implicit cost. Opportunity cost, therefore, on the other hand, opportunity cost is generally higher than accounting cost. Okay, because it includes both explicit and implicit cost. No, so that means to say, opportunity cost is relatively higher than What is uh, to make a long story short, when you compute accounting profit, okay, that is the total sales as total revenue minus explicit cost. But economic profit is actually total sales or total revenue minus the sum of explicit and implicit cost, which is actually the opportunity cost. So that means to say, uh, opportunity cost is much more higher than implicit, also let's say explicit cost. No. Now, why do we need to be particular about accounting profit and like for example economic profit? I'm going to strike a balance on that understanding in just a short while. But for this time, uh, we shall be we will. I'm going to give you a more specific example on really a typical firm that also use this particular concept. Now, in understanding the concept of economic profit, we take an example of you opening an internet cafe in Baybay. At the end of the month of operation, your bookkeeper tells you that the gross income was 100,000, the gross sales. And then the cost were 45,000. Okay, the cost niya 45,000 pesos, which leaves you a net income, or net income, a net of 55,000. 55,000 is accounting profit. Okay? 55,000 because straight away gideduct nimo ang accrued cost. That is actually explicit cost. Then 100,000 minus 45, you have a net accounting profit of about 55,000 pesos. Now, suppose that you are not the one running the business. You are not the one running the business. You could have been working in the bank as supervisor for about 20,000 pesos per month. Therefore, in essence, the economic profit is actually equal to 35,000. Okay, if if you were the ones managing it, and then you pay additional, say for example, you pay your labor equivalent to what you are actually receiving as, say for example, bank supervisor. That means to say there is an opportunity cost of your labor that needs to be uh, deducted also from 55,000 to be able to get the economic profit. Okay, the economic profit, because your labor is uh, is priced at 20,000 pesos per month. Yeah, wala man ka nag-charge di ana because ano man, ordinary profit naman imong i-compute or ordinary cost of labor. So, if you charge your labor cost plainly, so that means you get that particular amount of money. Now, you will deduct that particular amount of money, which is 20,000. No? So, in essence, your economic profit is 35, but your accounting profit is 55. Because ang labor ato, you did not deduct your labor sa 55 because ikaw itong iya. But then kung na opportunity ko sa imong labor, i-appeal nimo nang deduct dito sa ano. Okay? Note, if economic profit is favorably positive, then it can trigger an incentive to venture into this kind of business. In the context of the economist or economics, cost includes both explicit and implicit cost. What does it mean? In other words, if we decide on investment decision, if we do an investment decision, we are not only going to not only going to compute for accounting profit. Effective investment decision must base the decision must be based on the extent of or the magnitude of economic profit available. No? If the economic profit is positive, there is an incentive to invest in that particular like business. Because if economic profit is not anymore positive, then it's only able to pay variable expenses or maybe the accounting expenses, then it's too tight to that particular business is rather crowded already. It has squeezed out any possible excess profit which is manifested by the economic profit. No? So that is also one very important basis or usefulness. Why do we need to understand economic profit? No? So that is the reason there. No? Now, the role of profits also may gamit sa profit. No? We know already the concept of profit, economic and also accounting profit. Now, if you pay your tax, you use accounting profit. You don't compute for economic profit because economic profit is not registered with the BIR. No? When you pay your tax, you use your computation of your accounting profit. Wise kayo, no? You will end up paying more taxes than it was when you compute basing on economic profit. But that's the normal terms of trade, no? I mean, the way it is, everything is based on accounting profit in the normal course of, say for example, business operation. But the economic profit is only useful when we decide for allocation of investment or allocation of resources for investment. Now, another thing is the role of profit. Individuals who want to maximize profit often are considered self-interested or conscious selfish, a quality that many people view as undesirable. No? O, any individual nga very particular about profit, mingon ta nga sa bali, oy hinap gusto mo na manapi, something like that. But as I said, uh, we should have a more progressive view of the word, the term profit, no? Because if profit is not necessarily undesirable, no? Consider the Smithsonian argument. That means to say the argument of Adam Smith in his book The Wealth of the Nation. In his book The Wealth of the Nation, si Adam Smith man gyud na ang nagsulti ani, no? It is not out of benevolence of the butcher that the baker or the bread peddler that we the baker or the bread peddler that we expect our breakfast from their regard to their own interest. Okay, if we simplify this particular statement of Adam Smith, now it is not out of benevolence of the butcher or the baker or the bread peddler that we expect our breakfast, but from the regard of their own interest. Yeah. Dili man lang na sila. You think, for example, when pandesal gets into your plate every morning, okay, and then when the, for example, when uh, the the freshly cut or freshly cooked meat goes into your plate every morning because there is somebody peddling around or you bought that from very accessible location. Now they are doing that, the bread peddler and the butcher is doing that not because they are benevolent, no? Nga, mo, ano lang sila, mo provide sa ilang service. They are providing their service because they earn something. Okay? You pay the peddler, you pay the butcher, so that all the needed food items that is for breakfast will get into your house and into your table. But they are doing that not because they are benevolent, but because they want to get paid. In other words, their self-interest. Now, what is that? The money that they receive is profit. Okay? But the profit that they receive is also because they want to help you. They want to serve you. They want to provide you the needed food every day. So that is something that Adam Smith is trying to emphasize. As Adam Smith puts it, by pursuing self-interest, the goal of maximizing profit is achieved. No. A firm ultimately meets the needs of society. Any rational person or firm, therefore, puts his or her scarce resources in an option where maximum profit is generated. No, you don't just really go work every morning or go to somebody else's, say for example, business firm and wash dishes there or something like that. You don't just go there because uh, you just want to go there and without anything, but you want to go there because you want to get to be employed and get the money that you need for your own interest. But in the process of doing it, you are also serving others to be able to be to improve their access to basic services. So that is what Adam Smith is trying to emphasize. You want to put your labor in a in an alternative employment where you can get the best reward for your time. And that is very rational. No? You don't work on something that you don't get paid or utangon ra imong labor, but you work on something that you get paid and being able to feed your family as well. No? So that is just the logic. We help each other help themselves also or something like that. No, that's the logic of Adam Smith. You earn a profit because you want to serve people. Okay, you want to improve their access. You want to improve whatever that they need in life. So profit, after all, in that sense, is not bad. Okay, that's for example. That's why we also look that up, or say we consider that in marketing, that in marketing is serving the needs of your customer either through experience or through physical product. Serving the needs in marketing, you serve people first, and then the profit is just a natural result of being able to serve people, something like that. It is consistent with what Adam Smith is trying to to tell us. Adam Smith first noted this phenomenon is is due not to the phenomenon is due not to the benevolence of the part of the firm managers, but to the self-interest or the goal of maximizing firm's profit. No? So this was noted by Adam Smith. Yeah, the self-interest of the worker accomplishes the needs of the household, something like that. The principle is profit is therefore signal to resource holders where resources are most really likely to be used. You use that particular resource in an activity where it will give you the best reward or the best incentive. Okay? So that is also profit. It becomes a signal for allocating resources. So you must recognize that profits are signal. Signal to where to allocate your labor, where to allocate your money, etc. Or where to allocate precious inputs. Allocate where you that will give you the best results. No? So existing and potential competitors will do their best to get a piece of the action if there is a favorable profit that is earned. In the business world, there are five forces. Okay, in the business world, there are five forces of that influences organization's profit. Okay, five forces, di ba? We allocate we allocate our resources on an option or alternative that gives us the best result. Okay, so that will impact on profit. But in the business world also, there are five forces that influence that being able to get profitable result of your endeavor. Okay, we call it the five forces model of Michael Porter. No, what are these? You have uh, entry, no entry, power of inputs, and then you have power of buyers, industry rivalry, substitutes, and complements. Okay, so in that sense, entry could be barrier to entry, or it will also be a positive sign to enter into the business. No, so like this. No, these are the five forces affecting industry profit. And then if you know this, that means to say you have already some kind of like basis whether it is profitable to enter into that industry or business or not. Like for example, these are factors that influence industry profit. Okay, so you have, for example, entry cost. Entry cost, if it is easy to enter into a particular business, okay, if it is easy to enter into a particular business and that business is profitable, then many will be incentivized, many will be encouraged to enter into that business, since it will improve on industry profit or it will improve on profitability. Now, if there is, for example, on the other hand, if government restraint is very what is very uh, strict or very strong, highly regulated kind of business, then of course it will impact on profitability. That means to say only very few will be attracted to invest into that. That's why we need to have a policy that will be that is providing a good policy environment that is very engaging. No, and then you have also a another thing for entry. You have economies of scale. On something economies of scale, that means to say if the economies of scale requirement is so huge, only very few. Katurang yung mga dagko nga firm ma-encourage to invest, no? And then we have to there are other factors in that box, no? You can read this particular article in the material that I'm going to provide you. And then you have also power of supplier. What do you mean by power of input supplier? Those providing you inputs, are they organized or not? Okay, if they are organized, they can dictate the price. That means to say it will impact on profitability of your firm. No, so industry profitability will be affected if the these input supplier are so organized na you are practically at their mercy. Like for example, in sardines manufacturing, no? In sardines manufacturing, the producer of tin which is kaning lata, no? The producer of tin are operating or yeah, they are operating almost like a cartel, no? Almost like a cartel. They are so organized and they control the price of tin, the the packaging material for sardines, kaning tinapa. Can you imagine 40% of the cost of sardines gikan sa lata? I mean, lata wala pa label. So that means to say if they are so organized, they are strong, it will impact on sardines makers manufacturing profit, no? And then of course you have also another say for example suppliers switching cost or even government restraints. If government restraint is so strong, it can again impact on industry profitability. So power of buyers, this is the also the way the another aspect by which buyers are for example only very few or they are so organized. That means to say it's not easy to select buyers unless you are part of that network. You cannot even sell your goods to them, no? So if there is strong buyer concentration and then they control also the final price of your product, then your industry profitability will have less flexibility, and so on. Rivalry, industry rivalry, no? And then you have switching costs or even the price and quantity competition among so among highly, for example, if it is if industry rivalry is so strong and then there are so many competing on the same particular market, there is going to be a possibility that there is going to be a price war among you. That means if there is a price war, everybody loses at the end of the day, affecting industry profitability. And then down the line, you have also substitutes and complements. These are issues where the product that you are buying could be a substitute or a complement. If it is a substitute, then a fluctuation in the price of that particular, say for example, product. If there is a movement by which they favor the substitute other alternative product, then it will impact also on your industry profitability. So if you read the full text of, say for example, uh, competitive advantage analysis of Michael Porter, you will understand each and every details of these particular factors affecting industry profitability. I'm going to provide you the full material of Michael Porter's paper on this aspect, so that you will have you will have the full details of his, like for example, uh, paper. No, now, of course, these are the entry situation, the definition of the entry, and then entry cost, sunk cost, etc. No, and then you have, for example, you have a exporter. If you are an exporter, this is part of sunk cost analysis. No, so if if requirements for sunk cost is very high, that means to say you will also have to you cannot just enter into the industry because the sunk cost requirement is very high, affecting your industry profitability. So economies of scale, I've explained that, network effect, no, and then you have also the, for example, the reputation of the company, no. If the company reputation is so important, well, they it will really be it will really be difficult for others to compete, because there is a reputation that this company, this leading firm, is really protecting. That means it's difficult for you to enter, affecting your industry profitability also, or business profitability. Government restraints, power of the input suppliers, power of the buyers, industry rivalry, and also you have substitutes and complements. Now, let's proceed with understanding the ano, understanding the concept of incentives. No, understanding the concept of incentives. What are incentives, by the way? Incentives are different from profit. No, and while profit can be an incentive to invest for decision, but the incentives that we are talking here is incentive for people in the company or in the business. Okay, it could be the workers or whoever is part of the organization. Incentives. Now, as profit becomes favorable, the increasing use of organization resource will impact on the management effort to induce people to work hard and produce more. Okay. It will, if it is profitable, people will be encouraged to work hard and produce more. What is the role of incentives, therefore? How are you going to even encourage more people to work? Okay? Because may man sila. No, overtime lang yun taon niya. Kana bitong dako man tag profit nga no, wa may addition nga, wa may overtime pay or something like that, no? So people will always question us that. Therefore, within the organization, such as firm, and how to construct incentives to induce maximal effort for those or from those you manage. In other words, incentives more for the workers of your company, okay, or people behind you in terms of being able to produce something. Now, there is what we call as incentive compatibility condition. Okay, depending on the nature of the scale of your business, there are various types of profit-friendly incentives that we can consider. This will be dealt lengthily in the succeeding module, but this time we will also make a initial scratch from the surface in terms of the usefulness of incentives to encourage people to to produce more. No? So we have ano, uh, the trust of managerial economics is to provide you a broad array of skills that enable you to make sound economic decisions and to structure appropriate incentives within your organization. In other words, managerial economists or managers, ang trabaho sa manager is to design a sound economic, a sound incentives that will provide a strong and effective basis for managerial economic decisions, sound economic decisions. So that incentives is almost like the lubricant of productivity. Okay? Incentives now becomes a lubricant. That means very smooth ang increase to increase productivity if people see that they are incentivized. Okay? But if they feel that incentive is not compatible with their expectation, they will not put their best effort in working with you in the company. Okay, so that is very important. Incentive is very important because resources, physical resources, pwede na nagwa incentive, but you are managing people. Di pwede na. If your incentive is very poor, you will find yourselves abandoned by people who is working with you. There are several examples of compensation package that are useful in inducing productivity or profitability. So there are several types. No? One could be base pay, commission system, or profit sharing. No? Or a combination of various packages which are compatible under specific economic context of an organization. When you pay your workers, okay, you pay them either basic pay lang or basic pay plus commission, or you can also basic pay plus profit sharing in order for them to work uh, more fully to earn profit so that the quality of the product that they produce, good quality, so mo earn good profit. And then you have profit sharing. Or a combination of various ano various types. So these are the things that are being considered, no, in when we design incentives, no. For example, there are uh, in banks, for example, very common is siya in restaurant, in bakery, no, mga food, ano. I learned that in before we had this we had this we I work with, I mean, I partner with a friend who is operating a bakery in Baybay, and then we really see that the incentive of the baker, the master baker, is very important because the possibility or the likelihood of kanang mga pagod, kanang mga overweight or underweight nga tinapay, the possibility dako kay ng factor ang master baker kung sila man ang nag-estimate sa imong ano. And then of course the ano the quality of the bread, no. So that what it was part of his, like for example, compensation na ay basic pay monthly plus a profit sharing. If for example, if uh, less reject, if there is 90 to 100% no reject, no, gamay na kaayo ang reject, nina siya cut off po nga additional pay, no. So in other words, maningkamot siya nga wa jay reject, wa jay underweight or whatever, why mapagod, no. So that is something else. That is one thing for ano. Now for banker, for example, we have a graduate here already working in the bank, no. Daghang kaayo. Now they said that sometimes ang ilang profit sharing is much higher than their basic salary, no. I know of a friend who is already retired this time, working with a very huge bank like Metropolitan Bank and Trust Company. He used to work there as executive vice president. He said that he's only paid, for example, 450,000 a month. Comparably with other vice president in other banks, waras katunga ang iyang kuan, waras katunga ang iyang halos katunga ra ang iyang sweldo. But boy, ang iyang profit sharing very huge also. It's very small compared to the basic pay. So at the end of the year, he earns more as in terms of the profit of the company than from his basic pay. So that ang message sa company ato, be good. You have to really be loyal to the company and make it profitable so that at the end of the day, all of us will be benefited. So that was his experience. It's really something like that, no? Incentives. So I would say the last part, no, the last part of the module this evening will be on our discussion on understanding markets, no, understanding markets. So here in market, no, in a particular business, we are always like confronting or faced with a certain type of market. So you have what is the structure of your market, what is the conduct of your market. We have to understand that, and what is the performance of the market also. So structure, conduct, and performance, so that we'll be able to prepare ourselves on how to behave in the marketplace. Okay, there are two sides of every transaction in the market. One in the aspect of the buyer, and there is also another, the seller, ang nagbaligya, no? And then you have also the buyer. For every buyer of a good, there is always a corresponding seller. The final outcome of the market process depends on the relative power of the buyers and sellers. Okay, so you have to really understand how the market is structured. Is it competitive? Is it like uh, for example, monopolize, or is it a structure where there are only very few producer or seller or buyer or something like that? So understanding, so that we would be able to also prepare ourselves. What is our optimal strategy in terms of being able to enter the market or how to manage the market? Okay. In terms of relationship between buyers and sellers, now there are what? There are three sources of rivalry existing in the market. Okay. So because the rivalry in the market will also define the extent by which we would be able to operate our business in that particular industry. Okay, rivalry that exists in all economic transactions. Each form of rivalry serves as disciplining device to guide the market process. It affects different market to a different extent. Like for example, types of rivalry: consumer to producer rivalry. Okay, that means to say, uh, it could be like there are there are like there is a what consumer to producer rivalry. That means to say anuhan sila, uh, uh, like pakuhalay sa presyo, meaning pakuanay yun pa say nga ni like head on, no, di mo palit, di po mo baligya or something like that, no. This occurs because of the competing interests of consumers and producers. No sell policy. Okay? It will also hurt the ano the the buyer. Situation can happen if two rivals don't agree. Okay? That means to say, very important to have them agree and negotiate to a certain level in order to be agreeable with one another, and then there is selling transaction to happen. Because unless there is agreement, price becomes very unstable. And then the worst that can happen, if they really are not able to agree. But more often than not, this particular rivalry will have a strong inflationary pressure, because the the consumer or the buyer will really will have the power to will buy something that they can get so much benefit, but the producer want a higher price. Okay, so that there is really going to be a tug of war between the two. The inherent assumption of this one is that each one has equal market power, but more often than not not all of them or not both of them has equal market power. Naagay mo surrender. Okay? If the consumers are very weak or something that are not organized, they will become at the mercy of the producer. Okay. Consumer to consumer rivalry. That means pinuhalay presyo. Pinuhalay. That means to say they will really it will really find ourselves benefiting the competition of the consumer, because they will bid for a higher price. So benefiting the seller, no? Benefiting the seller. So if that is the case, then it is a very good situation. But if you are under a producer to producer rivalry, understanding your market that there is a rivalry between producer, really we need to we need to what we need to manage this competition with our kapwa producer in order to get the best price for our product. And one thing to do that is to really offer multiple products, so that not all our products will be competing in the market, no. And then the other one is government and the market. The government also will regulate the market. How strong is the government regulation? We need to know that, and also comply accordingly sa government. Because if we are If we fail to comply with the government regulation, we will also find ourselves losing at the end of the battle. No? So that is the that is the like uh, the essence of uh, what is required by, like for example, what is required by what is expected by a manager in order to really provide the capacity in making decisions that is going to result in effective direction of resources and manpower of the organization to achieve the goals of the firm or the organization. No, so that means to say, uh, we need to know what are the goals and constraints you are facing. Very important. That is the foundational, because that will allow you to be able to steer to a particular direction. Without that known, forget about doing productive activity. Okay, and then you also have to know the concept of profit. Okay, or the role of profit, be able to handle, and then of course incentive, very important ang incentive, no, understanding the incentive. How are we going to how are we going to encourage people to produce more, no? Now, how do you compensate? How you provide compensation to your workers in order for them to work effectively and productively. So dili lang it's not only that they are paid according to but we look for the best possible combination of incentives in order to encourage them to produce more. And the other one is also understanding about market. Very important ang market, so that we will position ourselves in the business in a way that responds to the dynamics of the market. Very important, because the market will make or can make or unmake our existence in the business, no. So we will have a more detailed elaborations and treatment on all these different aspects when we go to the succeeding modules of the course, because we are now going to address on some of those ticklish issues, especially on the aspect of incentives, especially on the aspect of rivalry, especially on the aspect of several others, on profit also. Now, we will deal with the nitty-gritty details of how these things are properly addressed in a technically sound um, approach, and also uh, technically and scientifically, say for example, plausible, say methodology. No, so we will have a more detailed discussion on that on the succeeding module. Now, what remains in this particular say module one to be discussed next week will be on the aspect of like understanding also the time value of money, and of course we have the of course marginal analysis and and few others, no, and few others that will be for next week. So uh, do you have am I getting my message across for all of you this evening?
Yes, sir.
uh,
Opo, sir.
okay, so thank you, and then I'll I'll stop sharing now, and I'll